We haven't talked a whole lot about the stock market in the past year or so because it's been doing what it generally does, gently rising up. It almost makes you forget that sometimes there can be a little bit of a wild ride, and that's what we've been on to start the week. It went down big on Monday, rebounded a fair amount yesterday, and may rebound more today. So how did we get here, and what is to come? To talk more about that, I'm happy to have back on the show Heath Grossman to break it down. He's a partner with Johnson Brunetti. Heath, good to see you again, sir.
Good to see you too, Tim.
Yeah, glad to have you here. Okay, first things first, whenever these things happen, a big 3% dip coming after it had already fallen last week, people start to get a little nervous. How nervous should they have been?
You know, it's definitely disconcerting, right? Like, it's not great to see that when you look at your accounts or you look at the stock market, you look at the news, you know, but if you're in it for the long term, you shouldn't make any big changes, right? Like, you got to tie the money to the time frame, right? Like, if it's money that you're not looking to use anytime soon, right, in the long run, it's going to grow.
Yes. Now, I want to talk about why in a second, but even before that, I want to ask, does it even matter for the average consumer, or should they just be aware that this is what the stock market is going to do from time to time for whatever reason?
You know, it kind of depends, right? Like, it depends on what the goal is for the money, right? For a lot of people that we speak to, this money is retirement account money, right? Money that they're saving to someday use in retirement. If you're 20 years old, 30 years old, you got a huge long time frame, so you should just ignore everything, right? Now, if you're 55, 60, 65 years old, retirement is imminent, or in the next couple of years, that's a little bit different story. That's where you have to do a little bit of a planning and make sure you're not taking on too much risk and subjecting yourself to too much of these potential downturns.
Yeah. Okay, so let's just say somebody's maybe 1 year from retirement right now. How should they take what has happened in the market this week? Is it still pretty much steady as she goes?
Well, it kind of depends. Depends if they've done any planning ahead of time, right? If they've protected themselves, if they've utilized other tools and strategies that are not so market focused, right? If they haven't done those things, probably a good time to maybe just reassess. I'm not saying that you should make big changes right away, but it brings to mind, like, let's reassess here, right? Let's take another look at whether we're positioned in the right way or not.
Right. Okay, now let's talk about the why, because maybe there is some predictive value for that. I'm hearing a lot of people saying that there's a number of potential reasons, but one is that there was some worldwide fear that the U.S. economy is at least slowing down and could be headed for a recession. I feel like we've been hearing that for years, though.
Some of this is to be expected, right? We got to go back to inflation, right? We've all been talking about inflation over the last couple of years, right? We've had high inflation coming out of the pandemic. And what we did is we raised interest rates, right? That is the playbook. That's the right thing to do.
Yes.
But ultimately, what is that doing, right? Raising interest rates will stall the economy over time. That has the effect of getting inflation down in check. So we should have been, you know, expecting this to some degree, right? But what you want to do is you want to do it in the right measure, right? Like, you want to raise interest rates incrementally and slowly, so it stalls the economy slowly in the right measure, right? Like, it's like if you're driving down the road and you see a stop sign coming up, you're not slamming on the brakes and going careening off the road. You're tapping the brakes lightly, coming to an easy stop, and then we're back into the intersection, right? So the next step would be lowering interest rates. All these things are cyclical.
Yeah, and one last, I guess, quick question. How good of a job have they done? I mean, I know we've gotten it down to about 3% inflation year over year. The target's 2%. Isn't that close enough to say maybe there's not going to be a recession going forward? I know I'm asking you to predict something that...
Yeah, you know, really at this point, we don't know. I think the, you know, the percentages of likelihood of recession is a lot lower than what you would have thought maybe a year ago. Time will ultimately tell. And so we got to see what happens. The next Fed meeting is going to be in September, so we're going to see what happens.
Yeah, so if you're just looking at your retirement account, remember, that could be a long time from now. Stay the course. You should be fine. Mr. Grossman, thank you so much.
Thank you.
All the good folks from Johnson Brunetti, always good at just helping us make sense of some of these things, Matt Scott, that can be very hard to discern, especially when it comes to macroeconomics and how the Federal Reserve works.